What if I told you one single SPX 0DTE contract made $1,290 in just 1 month? But if you had scaled that same strategy to 10 contracts, you would have had to sit through a $6,000 drawdown. That's exactly what happened in July. 15 trades, 13 winners, 2 losers, an 86.7% win rate, a profit factor of 2.77, and a maximum drawdown of $608. Now here's the uncomfortable part. If you multiply everything by 10, $1,290 becomes $12,900, but that $608 drawdown also becomes $6,080. So the real question isn't, can this strategy make $1,000? It's, can you keep executing when the numbers become emotionally difficult? Today I'm not showing you a backtest. I'm breaking down one real SPX 0DTE session from July 27th step by step. We'll cover the failed support, the GEX shift, the strike selection, the exact Iron Condor, and how we closed at 85% of maximum profit. And the most important part, the edge didn't come from predicting the market. It came from adapting to it. Let's get into it. Looking back, this session appears clean. It wasn't. Before the market opened, 7,450 stood out as a key support level based on the GEX structure. Institutional positioning around 7,440 to 7,430 added even more confluence, making it look like a textbook range day setup. In fact, I posted the full pre-market GEX chart and level breakdown inside my Discord community before the market opened, so everything was documented in advance, not after the move happened. That matters. Reviewing market structure before price reacts is very different from explaining it with hindsight. But within minutes of the opening bell, that entire thesis started falling apart. And this is where most 0DTE traders get trapped. The day started with a risk-on environment. Oil prices were falling, geopolitical tensions had cooled, and futures were showing strength. But within the first 30 minutes, that strength began fading. This is a 5-minute intraday chat of SPX. The biggest warning sign wasn't SPX, it was semiconductors. SMH reversed sharply, and Nvidia dropped roughly 2.4%. Tech leadership was deteriorating quickly. Meanwhile, the VIX wasn't exploding higher, it stayed relatively contained between 18.6 to 18.8. So now we had a divergence, weak technology stocks, but controlled index volatility. That's not panic, that's instability, and instability changes the way you structure 0DTE trades. Around 10 a.m., it would have been easy to flip aggressively bearish, but chasing breakdowns in 0DTE trading is exactly how traders get squeezed. SPX was still above Friday's close. The VIX wasn't expanding aggressively, and VWAP hadn't fully confirmed the breakdown. So instead of predicting what would happen next, we waited. There were only two scenarios. If price reclaimed VWAP, the bearish thesis would be invalidated. If price stayed below VWAP and broke the opening range, continuation became much more likely. This wasn't about being right. It was about conditional execution. That's a huge difference. Then the market made its decision. SPX broke straight through the 7,450 support level. And this is where many traders make an expensive mistake. They defend their original idea. They force a bull put spread. They average down below broken support. We did none of that. Once 7,450 failed, it was no longer support. It became potential resistance. So instead of fighting the market, we shifted our focus lower. Now 7,400 became the new reference point. Around 10:17 Eastern Time, the updated GEX data revealed something important. Institutional positioning appeared below 7,400, specifically around 7,385 to 7,380. Now we had structure on both sides. Above us was 7,450, acting as failed support and potential resistance. Below us was institutional positioning that could serve as a stabilization zone. That's when the Iron Condor became the right trade. Not because we suddenly felt neutral, because the market structure had defined a brand new range. The range shifted lower, so our trade shifted with it. At 10:25 Eastern Time, we opened the position. On the put side, we sold the 7,370 strike and bought the 7,365 strike. On the call side, we sold the 7,455 strike and bought the 7,460 strike. The position collected a $1.30 only. With a spread width of 5 points, maximum risk is $370 or $368 per Iron Condor. That gave us an expiration range between 7,370 and 7,455, an 85-point window. The put side sat below institutional positioning. The call side sat above the failed resistance level. Was it aggressive? Yes. Was it emotional? Not at all. It was structured, defined risk, and an updated thesis. Now here's what separates amateur traders from professionals. We didn't simply set the trade and walk away. Our initial take-profit target was 75%. Later, we tightened it to 81%, then again to 85%. We ultimately closed the position for 20 cents. That turned a $1.32 credit into a gross profit of $112 per contract. So why not hold until expiration? Because 0DTE options can erase hours of premium decay in just a few minutes. Removing late-session exposure isn't a weakness, it's part of the strategy. Defined entry, defined risk, defined exit. So what actually made this trade work? It wasn't the Iron Condor itself, it wasn't luck, and it definitely wasn't prediction, it was the process. First, 7,450 was identified as support, then support failed. The original thesis became invalid, the range was redefined lower. Institutional positioning confirmed the new structure, the trade was rebuilt around that updated information, and profits were locked in before volatility returned. Adaptation beats prediction. Most traders become emotionally attached to their bias. Professionals update their bias when new information appears. Now, one trade doesn't prove anything. That's why I track the entire month publicly. 15 trades, 13 winners, 2 losers. A total profit of $1,290 using just one contract. A maximum drawdown of $608. And consistently documenting these trades is actually why the Reddit community has grown to more than 600 members. Every session recap includes GEX screenshots, strike selection logic, entry timing, exit adjustments, and even losing trade reviews. Not just the green days, because the real edge comes from studying market structure, not celebrating wins. If you'd like to see the complete July 27th breakdown with charts and timestamps, it's archived inside r/GEX options trading. Everything is documented there. Now let's come back to the scaling discussion. One contract produced $1,290. 10 contracts would have produced $12,900, but the drawdown would have scaled too, from $608 to over $6,000. Scaling magnifies psychology, not just profits. And things like commissions, slippage, and execution friction don't scale perfectly either. That's simply arithmetic, not a guarantee. If you want to follow these market discussions live, that's exactly what the Discord is for. Reddit is where I archive the full breakdowns. Discord is where we discuss daily GEX levels, VWAP reactions, and range shifts as they happen in real time. You'll find links to both in the description below. At the end of the day, the edge wasn't predicting where SPX would go. The edge was accepting when the market proved the original idea wrong and rebuilding the trade around new information. If you found this breakdown valuable, make sure to subscribe. Every video on this channel covers real trades, real market structure, and real risk management. No hindsight fantasy, just execution. I'll see you in the next session.